Silver just broke down hard, slipping under $23 after failing, again, to hold above $24.50, and the warning signs stacking up right now suggest this drop might not be finished. In the last 5 trading sessions, silver is down nearly 6%, while gold has held relatively firm, pushing the gold to silver ratio back above 90, a level that historically shows stress in silver specifically. But here's what should really get your attention. Futures volume spiked during the sell-off, not the bounce. That tells us this wasn't just weak hands panicking. I mean, it was aggressive positioning. So the big question is this just a healthy pullback before the next move up, or the start of a deeper correction most retail investors aren't ready for? In this video, I'm breaking down 3 clear signals that suggest silver could slide further, and what you need to watch right now. Welcome to Paper to Atoms, where we cut through the hype and focus on the data that actually moves precious metals markets. While a lot of channels chase headlines or push permanent bullish narratives, here we look at positioning, flows, structure, and real supply-demand mechanics, because that's what drives price over time. If you want serious silver and gold analysis without the noise, make sure you're subscribed to Paper to Atoms right now. We track these markets consistently, and when conditions shift, you'll know why. Not just that it happened. And do this for me. Drop atoms in the comments so I know who's here for real research, not just price hype. I read those and it helps shape future breakdowns. All right, now that we've set the stage, let's get into what just happened with silver, because the price action over the last few sessions is telling a much bigger story than most people realize. Let's start with the raw numbers, because the price action in silver over the past few sessions has been anything but random. Silver opened the week trading near 24.60, briefly pushed above 24.80 in early futures trading, and then reversed sharply. By midweek, we saw a flush down to an intraday low near 22.90 before a small bounce that failed to reclaim $23.50. As I'm recording this, silver is hovering around $23, down roughly 6% on the week and nearly 9% off the recent swing high from earlier this month. Now compare that to gold. Gold pulled back too, but much less aggressively, down about 2% over the same period. That divergence pushed the gold to silver ratio back above 90, after it had been compressing into the mid-80s. Historically, when that ratio expands quickly like this, it signals risk-off behavior and disproportionate pressure on silver's more speculative side. Volume is another key piece. According to CME futures data, trading volume expanded noticeably on the down days, especially during the break below $23.50. That tells us this wasn't just light retail selling, it was larger positioning, likely funds adjusting exposure as momentum shifted. Timing matters too. The sharpest part of the move came right after silver failed to hold above its 50-day moving average, a level many systematic traders and algorithms track. Once that gave way, sell stops likely accelerated the move, creating that fast drop into the 22s. Zoom out a bit further. A month ago, silver was trading closer to $21.80. So yes, we're still above those levels. But the failure to hold recent highs combined with heavy downside volume suggests this is more than just a quiet consolidation. Here's the deeper issue. When a market rallies, stalls, and then breaks lower on expanding volume while its sister metal, gold, holds up better, it often signals liquidity leaving the higher volatility asset first. Silver tends to amplify moves in both directions, and right now, that amplification is to the downside. So the surface story is silver pulled back. The real story is momentum flipped, positioning shifted, and key levels failed. And that sets up the technical picture we need to look at next. Now let's break this down technically, because the chart structure is where the real warning signs start stacking up. On the daily chart, silver recently rejected the $24.80 $25 zone, which has acted as resistance multiple times over the past year. Each time prices approach that area, sellers have stepped in. This latest rejection created a lower high relative to the previous rally attempt. A subtle shift, but an important one. Markets in healthy uptrends make higher highs. Failing to do that is the first crack in momentum. From there, silver rolled over and sliced below its 50-day moving average, which was sitting near $23.70. That level had been acting as dynamic support during the prior advance. Once price closed decisively below it, short-term trend traders likely flipped bias from buy the dip to sell the bounce. Next key level down is the $22.80 $23 support zone. This area held during multiple pullbacks over the last 2 months, so it's not just a random number, it's a structural level where buyers previously defended price. We already saw an intraday probe into that zone. If silver starts closing daily candles below $20.80, the next major support doesn't come in until around $21.50 $21.80, which lines up with prior consolidation and the 200-day moving average. Now let's talk momentum. The Relative Strength Index, RSI, on the daily time frame has rolled over from the mid-60s down toward the low 40s. That shift tells us bullish momentum has faded, but we're not deeply oversold yet. In plain English, that means there's still room for price to drop before technical traders start aggressively calling a bounce. Volume also confirms the shift. Down days have come with expanding volume, while bounce attempts have been lighter. That's classic distribution behavior. Stronger hands selling into strength rather than accumulating dips. Zooming out to the weekly chart, silver is still technically in a broad sideways range between roughly $20 and $26. But here's the catch. We're currently rolling over from the upper half of that range, not the lower half. Historically, that positioning increases the odds of a move back toward the middle or even the bottom of the range before any sustained breakout attempt. Short-term, silver is in a downtrend on the daily time frame. Medium-term, it's range-bound. Long-term, the structural bullish case can still exist, but the chart right now is signaling near-term pressure, not immediate upside. So technically, the market is saying unless silver can quickly reclaim 2370 and then push back above 2450, the path of least resistance in the short term remains lower. And that technical pressure starts to make more sense when you look at what's happening on the supply and demand side. Now here's where things get interesting, because while the long-term fundamental story for silver still has strong elements, there are also short-term demand and flow dynamics that can absolutely pressure price in the near term. Let's start with supply. Global silver mine production runs roughly in the range of 830 million ounces per year, according to industry estimates from groups like the Silver Institute. But here's the key detail most people miss. The majority of silver is produced as a byproduct of mining for copper, lead, and zinc. That means silver supply doesn't quickly respond to price. Even if silver drops, mines don't shut down just because of silver. They're driven by base metals economics. Above-ground supply is where things get more flexible. Exchange inventories, especially on COMEX, act as a visible buffer. When inventories are rising or stable, it suggests the market has enough metal to meet delivery demands. When they fall sharply, it can indicate tightening conditions. Recently registered inventories, the metal readily available for delivery, have been relatively stable to slightly higher compared to the sharp drawdowns we saw in prior years. That doesn't scream immediate physical shortage. It tells us the physical side isn't currently forcing price higher the way some investors might expect. Now let's look at demand, because this is where short-term pressure can sneak in. Industrial demand makes up more than 50% of annual silver consumption. Solar panels, electronics, electric vehicles, and various industrial applications all rely on silver's conductivity. Long-term, that's a powerful structural tailwind. But industrial demand is also economically sensitive. If global manufacturing slows, even temporarily, silver demand can soften. We've seen mixed signals in global PMIs and manufacturing data recently. Slower industrial momentum doesn't collapse silver demand overnight, but it can reduce the urgency of buying in the short run. Investment demand is the other big driver, and it's much more volatile. ETF flows, futures positioning, and retail coin and bar purchases can swing dramatically based on sentiment. During strong rallies, investment demand surges. During pullbacks or rising uncertainty in other markets, it can stall. Right now, futures positioning suggests some speculative length has been reduced, meaning traders who were betting on higher prices are trimming exposure. That doesn't mean everyone's bearish. It means the market is less crowded on the long side than it was a few weeks ago. Here's the bottom line. Long-term structural demand from green energy and electronics still supports silver. But in the short term, stable exchange inventories plus softer speculative and industrial momentum can remove the immediate pressure that drives sharp upside moves. And when the physical market isn't tight enough to override financial selling, price can drift lower, even if the big picture story remains intact. That's exactly why we need to pause for a second and reset, because what comes next is the macro layer that could either accelerate this drop or flip the script fast. All right, let's pause for a moment, because we're halfway through and I want to make sure you're tracking the most critical insights so far. Here's the recap. Silver has failed key resistance broken below the 50-day moving average and is showing momentum and volume patterns favoring a further pullback. On top of that, short-term supply and demand dynamics aren't strong enough to offset selling pressure, and speculative positioning is lighter than it was during the recent highs. In short, everything is lining up for potential near-term weakness. Now, if you're getting value from this breakdown, this is the perfect moment to subscribe to Paper to Atoms. We do this deep, data-driven analysis regularly, and missing the next swing could be costly if silver starts moving aggressively again. Hit the like button as well. It genuinely helps more people see this analysis before the next major move. Coming up in the second half, I'm going to show you the geopolitical and macro forces that could tip the scales either way. and break down why most traders are missing a hidden risk that could accelerate this correction. To understand why silver could drop further, or reverse suddenly, we need to zoom out and look at the bigger forces shaping the market. These aren't just numbers on a chart. They're systemic pressures that can amplify price moves. First, let's consider central bank policy. The Federal Reserve has signaled a slightly more cautious stance after last year's aggressive rate hikes, but short-term rates remain historically high. When interest rates are elevated, the opportunity cost of holding non-yielding assets like silver increases. Investors tend to rotate into interest-bearing instruments, putting pressure on metals. Meanwhile, the European Central Bank and other major central banks are also maintaining tight policy, which is keeping the US dollar elevated relative to most currencies. Currency dynamics matter a lot for silver. The dollar index, DXY, is currently hovering near a multi-month high. Silver, like most commodities priced in dollars, tends to move inversely to the dollar. When the greenback strengthens, silver and other metals face headwinds, even if physical demand remains solid. That explains part of the divergence we've seen between silver and gold over the past few sessions. Gold is more defensive, silver is more volatile and sensitive to dollar strength. Fiscal policy and government debt also weigh in. Global deficits remain elevated, and debt-to-GDP ratios in major economies are climbing. In theory, this is bullish for precious metals over the long term, as it undermines fiat currency confidence. But in the short term, markets can still be dominated by liquidity flows, interest rates, and positioning, which can push silver lower even when the macro picture eventually favors it. Geopolitical tensions add another layer. Rising uncertainty in east-west trade, energy supply, and strategic mineral stockpiling can influence industrial demand for silver. For instance, China's silver consumption for photovoltaics is a key driver of global demand. Any slowdown or policy shift there, like export controls or slower infrastructure spending, can reduce immediate demand, putting additional pressure on price. Finally, systemic risk signals are worth noting. Credit spreads, bond yields, and global liquidity conditions are showing pockets of stress. When confidence wavers, capital flows to gold more than silver, leaving silver vulnerable to sharper short-term corrections. So here's the takeaway. Macro and geopolitical factors are creating a perfect storm for near-term volatility. Dollar strength, tight rates, industrial demand sensitivity, and speculative positioning all intersect to make silver prone to further weakness. Yet these same forces could flip quickly. Any sudden dovish pivot from the Fed, a surge in industrial demand, or physical supply stress could trigger a sharp rebound. Understanding these larger forces is critical, because it sets the stage for risk analysis and balancing your perspective, which we'll cover next. Look, I want to be clear. While the charts and macro factors are signaling potential near-term weakness in silver, that doesn't mean the market is doomed. Being realistic about risks actually strengthens your decision-making. First, the bearish scenarios. Silver could pull back further if the US dollar rallies sharply, perhaps on stronger than expected economic data or another round of hawkish commentary from the Fed. That would put immediate downward pressure on both retail and speculative positions. A break below $22.80, which we discussed earlier, could accelerate a drop toward $21.50 or even $21, testing long-term support levels. On the supply side, any unexpected increase in above-ground inventory or new mine output could also ease tightness and put additional pressure on prices. Volatility is another factor. Silver can move violently in short periods. Pullbacks of 10-15% in a few days are not unusual, especially when technical support levels fail and speculative traders exit positions. If you're not prepared psychologically and financially for that, you risk being shaken out at precisely the wrong moment. But here's the balanced perspective. Long-term structural demand remains intact. Green energy, electronics, solar, and EV adoption continue to support silver fundamentally. Historically, pullbacks like the one we're seeing often create opportunity for disciplined accumulation, especially when broader macro fundamentals remain sound. Finally, a critical disclaimer. This is educational analysis, not financial advice. I don't know your personal risk tolerance, financial situation, or investment goals. Always do your own research and consult professionals if needed. Never invest more than you can afford to lose. So in short, silver's near-term path shows risk, but the structural story is still bullish. Understanding these risks allows you to navigate volatility instead of reacting blindly. Here's what I'm watching closely over the next week or two and what you should be tracking if you want to stay ahead in the silver market. 1. Key price levels. Watch 2280 support and 2370 resistance. Where to find it? CME group charts or TradingView. What it means? A sustained break below $22.80 could signal a move toward $21.50, $21.80. Conversely, reclaiming 2370 and holding could indicate buyers are returning. 2. COMEX registered inventory. Watch weekly changes in silver inventory. Where to find it? CME Group, COMEX reports. What it means, a sudden drop in registered silver could indicate tightening supply, providing short-term support. A rise could signal lower physical demand pressure. 3. ETF flows and physical premiums. Watch physical silver ETFs and dealer premiums over spot. Where to find it? Bloomberg, Kitco, and local dealers. What it means? Increasing ETF holdings or rising premiums suggest growing physical demand. Weak flows or declining premiums suggest sentiment is softening. 4. Dollar index, DXY. Watch key levels around 105, 106. What it means, dollar strength historically pressures silver. Any sustained weakness could trigger short-term silver rallies. 5. Macro and geopolitical updates. Watch Fed announcements, PMI data, and industrial trends in China. Where to find it? Fed website, financial news sources. What it means, unexpected dovish signals or higher industrial demand can reverse near-term silver weakness. Thesis checkpoints. My short-term bearish thesis holds if silver stays below $23.70 with weak volume on bounce attempts. My long-term structural thesis remains intact as long as industrial demand and supply constraints continue. Viewer homework. Track these metrics daily or weekly. Notice how silver reacts when one or more signals shift, like a dollar pullback coinciding with a decline in COMEX inventory. Patterns like these give early warning or confirmation of the next move. Remember, this isn't just about watching numbers. It's about connecting the dots and making informed decisions in real time. All right? If you made it this far, you're serious about understanding silver, and that means you need to be subscribed to Paper to Atoms. Here's why. We're tracking this story daily, analyzing positioning, supply, and macro forces, and the next major move could happen while other channels are still recycling old headlines. Hit that subscribe button now so you don't miss critical updates, and while you're at it, smash that like button. It literally takes a second, but helps this analysis reach the traders and stackers who need it most. Now I want to hear from you. Drop a comment below. Do you think silver breaks 2280 in the next 2 weeks? Yes or no? Are you accumulating physical silver now or staying on the sidelines? If you've had success recently, timing a good entry, holding through volatility, or just staying disciplined, share your story in one sentence. It motivates others and shows that patience pays off. Before you go, here's something to think about. What happens if industrial demand spikes while COMEX inventory continues to drop? This isn't speculation. It's a scenario that could create violent moves in both directions. And right now, it's a hidden risk most traders aren't watching. In the next video, I'll break down the top 3 macro indicators that could trigger silver's next major rally or breakdown and show you how to position for both scenarios without getting caught off guard. You're not going to want to miss it. This is Paper to Atoms, where we turn research into reality. Stay sharp, track the data, and remember, every atom counts. I'll see you in the next one.